Hello all, this is David Rodriguez, quantitative strategist for dailyeffects.com, here to talk about the dollar and what we most care about, what could bring relief for the US dollar, or really anything for the US dollar, to be very honest with you. So let's dive straight into charts and see exactly what I'm talking about. Well, the simplest thing is the fact that the dollar tends to do well when markets are active. When the S&P 500 is not hitting fresh record highs on a regular basis, and when, traders are actually scared, they typically tend to seek the relative safety of the US currency. Well, right now we see FX volatility prices continue near their lowest levels since the onset of the financial crisis. And why does this matter? Well, because if you're a trend trader, and most professionals are, you're not going to all of a sudden bet that tomorrow volatility will take a 180-degree turn and go significantly higher. This in itself breeds complacency. The fact that we're in a sharp downtrend for volatility in itself hurts demand for volatility and, by extension, the US currency. And we can further illustrate the point just by looking at the specific chart. Just look at a simple correlation study between, our 3-month volatility index, which takes volatility prices across the major currencies, versus the Dow Jones FXCM Dollar Index. It's not as strong as it has been, but it's still fairly clear. As volatility goes, so does tend to go the US dollar. Again, this is a big deal. Until we see a real break here, there's not much scope for an important dollar reversal. So what does it come down to? Realistically, a lot of this comes down to the fact that, as I mentioned in passing earlier, the S&P 500 continues to trade near significant highs, although I will point out that the S&P 500 futures price has yet to eclipse the high set on, the 5-year anniversary of the low set back in 2009. And I'm talking specifically about March 7, when the S&P 500, the fair value of the S&P 500 futures price hit about 1890 and has yet to eclipse that figure. So watch out for that. But in the meantime, right now we're seeing the S&P 500 volatility index trade near 14%, which, in the context of this chart doesn't look that low, but in a historical sense is extremely low. No one really fears the next big thing. Well, what will ultimately bring the change? What brings relief? An end to this complacency. And again, I will stress the fact that we have yet to clear the futures price high set in the S&P 500 from earlier this month. And specifically, my colleague, Christian Kerr, points out that the next week in particular, or even the end of this week, brings a potentially significant turn cycle in the Dow Jones FXCM Dollar Index, which, given the fact that markets are so interrelated, could in fact bring the relief we're talking about. In concrete terms, I'm watching the fact that the Dow Jones FXCM Dollar Index continues to stick to this big trading range. And it's something I said at the end of last week, the beginning of this week. Look, until we breach either 10,600 to the top side, which would obviously be dollar bullish, or 10,500 to the downside, there's just not much in the way of trades. You might buy the low, sell the high, and that's actually worked fairly well. In fact, had you sold 10,600 earlier, at the end of last week, you would be doing pretty well right now, hindsight being 20/20. But realistically, we're going to need to see a breakout here. And if you're a dollar bull, my enthusiasm is waning, I will say that. But you do note that 10,600 is a big level here, and there's a confluence of the 55-day, 100-day, 200-day, and 52-week moving averages right here within 40 points of each other. So it's kind of like a big price target for the greenback. The question is, are we realistically going to see that kind of move in the next few days? Time will tell. We're keeping a close eye. Sign up for email updates. Contact me or anyone on my team on Twitter. Best of luck trading, and I'll talk to you soon.